And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It's the second best day of the week as we get ready to wrap up the week already. Here we moving into the middle of August. Of course, September right around the corner. Lots happening in September, of course. We have typically one of the weaker months of the year, seasonally speaking, right? That's September, October. That's when you tend to have, kind of bigger downside events that have occurred historically. Why October? Black Monday, Black Friday, they all tend to occur in October for some reason. It's just that, so it's like a magnet, right? Just attracts bad stuff, and you have Halloween. So
because the weather's nicer.
That's true. Yeah. This is true. Also too, coming up in September, we've got another Fed meeting. Of course, they'll be talking about, what their next rate hike is. Yesterday, we're going to get a lot more into the inflation data this morning with Michael Leibowitz, but yesterday, of course, CPI came in weaker than expected, came in at a 0 print at the headline. And again, we've been talking about for a while now that inflation was likely peaking, and we may have now seen that peak in inflation, but part of that's due to lower energy prices, but homeowners equivalent rent, a big component of the CPI calculation, has not really come down yet. So again, we've got to see some more action there to see more disinflation in the environment as we move later into the year. The dollar did drop out of its uptrend. That's also going to help support stronger asset prices near term. Also should provide a support to commodity prices, except for the fact that the Fed is continuing to hike rates, and that tends to be a headwind for commodities. So we have a lot of challenges right now going on in the markets. Between the Fed is still hiking rates. Yesterday's weaker inflation print did bring down the odds of a 75 basis point hike in September to just 50 basis points. So again, still hiking rates, mind you, still tightening monetary policy here. Restricting money supply, of course. We're also still tightening the balance sheet. No real evidence of any change in that dynamic at all. But this idea that inflation is peaking suggests that maybe they'll start to back off some of their more harsh rhetoric, right? More of that hawkish tone to the inflation fight. That gave stocks a bit of a lift yesterday. Now, importantly, a couple of things happened yesterday of note. The S&P did break above the 4,200 level. Now, that was kind of this support level or resistance level that we'd seen previously back here in these May-June highs we talked about yesterday. We did break above that. We were in this little consolidation in prices over the last few days, kind of leading up to inflation. Everybody was like, not really sure what was going to happen. And so stocks really kind of just moderated here for a few days, kind of consolidated a bit, and then yesterday on that weaker print, stocks, and as we said yesterday morning, if it was a weaker than expected print, stocks would surge higher, and that's exactly what happened. Stocks broke above that, about a 2% up day yesterday for the S&P. Again, indicators really kind of across the board now back to very overbought conditions. Also suggests here, again, that a lot of this upside, this rally that we've had, has really put a lot back into the books. The good news is that we now have a lot of bullish sentiment coming back into the markets. The American Association of Individual Investors, those are retail investors that they survey, they were deeply negative about the markets just a few weeks ago. A lot of bullish activity now starting to come back in their sentiment. They're getting a lot more bullish about the markets. Also, we're starting to see the average kind of increase here in terms of allocations now starting to pick back up again. So a lot of that negative kind of sideline that we saw over the course of the last couple of months because of the decline in the market is now starting to reverse. So as we're starting to see more bullish action in stock prices, we've got the 20-day above the 50-day moving average. We've got the market back above the 100-day moving average. This now puts the 200-day moving average inside here. And here's kind of an interesting antidote about all this is that we've now completed a 50% retracement of the peak to trough decline. So if we go back to the highs of the market in January to the lows that we just put in, we've now done a 50% retracement of that. That is actually very bullish. Going back in history, anytime the market's made a 50% retracement of that previous decline, new highs are in the offing. So, we're going to see here how the markets behave over the course of the next few months. But if we continue to kind of get good economic news, yesterday the Atlanta Fed increased GDP estimates for the third quarter to 2.5% annualized growth. So those first two quarters of weakness now starting to show some signs of strength as really starting to see a little bit of pickup. Strong employment report certainly helped in that report. Weaker inflation will also help kind of pave the way here for better economic data as well. And so again, if we go back in history, here's kind of the interesting part about this. Go back in history and look at markets. We have not been in a bear market, right? We've been in a correction. Now, what's the difference between a bear market and a correction? A bear market is when prices are trending negatively, right? So the previous bullish uptrend in prices have now been broken and stocks are trending negatively over a fairly long period of time. A correction is a market decline that doesn't break that previous bullish trend of prices and then recovers to all-time highs. We're clearly in a correction right now. We have not broken that long-term bullish uptrend that began back in 2009. And with this now 50% retracement of the decline, if the markets do rally back to all-time highs, yep, we've been in a correction. So that's going to be your kind of defining trigger here. So will, the Fed continuing to hike rates, continue to weigh on asset prices? A lot of this is going to come down to earnings and economics over the course of the next several months. And particularly as we get into 2023, have stocks priced in the worst of earnings? You can maybe make that case on some companies that are down 70, 80% from their peaks. But has the market in general priced in weaker economic and weaker earnings data over the course of the next few months. We don't know that just yet. We'll have to figure that out as we go, because the question is now going to be, again, how aggressive is the Fed in tightening policy? Do they over-tighten? Is the economy really in a position to where unemployment is about to become a problem? Are a lot of the more dire economic outlooks that we've talked about here on the show lately, will those come to fruition, or is the economy actually in better shape than it seems if inflation does peak and come down? You see, these are all the questions that we've got to work through here in terms of the portfolio management side of the business, right? So in terms of investing and looking at outcomes, there's so many conflicting questions and conflicting data at this point. Makes it very difficult here to make a really strong case to have a lot of money invested in equities, because this market could change dynamics very, very quickly based on a change of economic data, a rate hike that goes too far, a whole variety of impacts, and not to even mention what happens globally, right? There's a lot of the global indicators also suggesting more recessionary backdrops into the global economy as well. That will, of course, feed into the economic data here in the U.S. as well. So again, you can make a very good bullish case for the markets technically short term, fundamentally still a problem over the course of the next several quarters, particularly with the Fed hiking rates and, of course, tightening their balance sheet. That's extracting liquidity from the markets. So in the near term, continue to focus on these short-term indicators. They are overbought. Suggests that this market has probably done a good bit of its rally short term. Where we get a pullback to will be very critical here. A pullback to about 4,000 on the index, which would be right around the 50-day, 20-day crossover. If that is a pullback that holds that support, that will probably be a very good buying opportunity to put some money to work in the markets. A break of that, of course, and we're going to start setting new lows. But again, you're going to need some type of catalyst to start pushing stocks back to new lows at this point, because we've now made a more bullish transition to the markets. Got a lot to talk about this morning, of course. We'll go through all of this. We'll talk about the CPI data, what it means to the markets, how positioning goes from here, and kind of what to be expecting over the course of the next several months. That's coming up with Michael Leibowitz this morning. Be sure and get by the website, realinvestmentadvice.com. Sign up for our daily commentary that's out this morning at 7:30. We'll email you if you're signed up for it. And also our newsletter, which will be coming out this weekend. It's all at the website, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It's 6:17 as we get the show underway. Gregory Foster. Ring a bell? Brent, no? Don't know who Gregory Foster is? Set a world record. Set a world record. He actually set the world record back in November of 2021, but he was just recognized this Monday by the Guinness Book of World Records.
I shudder to ask what the record is that he set.
17 ghost peppers in 60 seconds.
Oh, man.
Now, talk about inflation.
Yeah.
Yeah, he's going to be sleeping on the couch alone for about a month.
Wow.
But yeah, that's I don't that there's a part that there's some records that you could just go, yeah, I don't really need to break that record.
Yeah,
that's
he can have it.
That's just that's all. The guy that ate one in 60 seconds and lived.
Good for you.
That's your record. Nobody will ever need to touch that again. 17.
Yikes.
You just must have no taste buds at this point, right? I mean, it's
at this point, he probably doesn't.
Yeah, it just has to be completely over with at that. That's pretty incredible. Anyway, just amazing me. I'll tell you a joke later.
Off air.
Anyway, Michael Lewis joining this morning. So a couple of things. Yesterday, of course, as I said, we had this initial report of, I shouldn't say initial report. We had the monthly report of CPI. And, this was what, markets had been kind of waiting for. And markets had just been kind of trading sideways for about a week or so, not really making a lot of advance. And, it's interesting that, the inflation number came in at 0% yesterday. So that was the headline number. And the core was up about 2%, but weaker than expected really across the board. And I thought some of the comments by the mainstream analysts were quite interesting. When you start looking at, Principal Global Investors, this is a textbook bear market rally. Technicals and sentiment drove the upturn and momentum is carrying it for now. Markets have become overly optimistic about the Fed outlook and even the economy. But as we get into quarter four, earnings growth will show clear signs of struggles and inflation will be easing only slowly. Now, take that one, which is one kind of a setup that we've talked about here for a while. And you kind of, put that against Jim Paulson who's the chief investment officer at Leuthol Group. Wow. Finally, this is his quote, by the way. Wow. Finally, the anecdotal evidence that inflation was easing has finally showed up in the mainstream inflation report. The Fed is rapidly losing its case for further tightening, and this report reinforces for investors that either a new easing cycle has already begun or we are very close to getting one. So, two very diametrically opposed views about inflation. And this is the challenge, and this is kind of what I was saying a few minutes ago, at the start of the show. There's so many cases that you can make right now for the markets. I can make a very bullish technical case for the markets. 50% retracement of the entire decline. Historically, there's no point in history that I can find so far where the markets have retraced 50% of the previous decline and did not go to new all-time highs. Okay. So there's a lot of case to be made bullishly as to why you want to have, money invested in equities. However, again, when you start looking at, the reality, the Fed is tightening their balance sheet. They are hiking interest rates. You can make a very strong case, and economic data, of course, is not great with inflation, even at 8.7%. That's still weighing on consumers. Very tough here to make a commitment to owning equities. So again, it's just, this is the challenge. It's the classic bull versus bear case, and the reality is if you don't pick it right, it's got consequences for you. Mike, good morning. Welcome to the show.
Good morning. How you doing?
Good. So what was let's just kind of get into the nuts and bolts yesterday. What was, we've been talking about now for several months that inflation was going to peak. We're going to see some weakening here. What was your initial reaction?
Before we go to that, can I just comment on the quotes?
No, not at all. Please go to the question I asked you and stay with the show, please. No, I'm teasing. Go ahead.
So if you listen to both of those quotes, I didn't hear the word earnings.
Right.
Right. In theory, we buy stocks because of earnings. You're buying those future sets of earnings. Neither one of them said, bullish or bearish, said anything about earnings. Both of their forecasts really focused around the Fed and how inflation would affect the Fed. And this is something we've been saying over and over and over again. It doesn't matter. I mean, unfortunately, it really doesn't matter what the fundamentals are. And that's stretching it a little because it does matter. But what matters probably most is what the Fed is doing. Are they raising rates? Are they lowering rates? Are they taking liquidity out of the markets? Or are they putting liquidity in the markets? So, this is a really tough point because inflation, we've been thinking it's going to peak for the last few months. It probably has peaked. But to be honest, the year-over-year rate has been between 8 and 9% now for 5 months running, and it's really just like topping. It hasn't falling rapidly. So, it's one thing to say it stopped rising. That's great, but it's still 8.5% year-over-year. That's a massive rate. Now, 0% for the month of July is great. Let's get that for another year, and we're home again. But that's not necessarily the case. So, when I kind of think about that bull bear, I too, like you, Lance, I can make, and we do it all the time when we have our discussions. A bull case gets offset with a bear case, and sometimes we're on one side of the fence, sometimes we're on the others on our debates.
Yep.
But what I focus on is the Fed, and the Fed's tricky. The Fed will lie to our faces and do something else, and they've done that time and time again. But we do know that QT is ramping up to 95 billion this month or early next month, and they're going to be withdrawing basically 95 billion of liquidity out of the markets. At the same time, they will raise rates in September, and the question remains, is it 50 or 75 basis points? And they will likely raise rates at the meeting after that, November or early December. Could be another anywhere from 25 to 75. That's still a little bit too far off. And everything the Fed has told us is that they will continue to raise rates. They're not going to take their foot off the brake until they are confident inflation is lower. And they have been humbled, and that's being generous, by inflation. Remember, a year ago, inflation was transitory. When inflation was at 5%, 5.5%, 6%. Well, it got up to 9.1%, and they didn't see it coming at all. So I think their concern about inflation forecast will, cause them to stay on the hawkish side. So you look at the inflation number, and what do they continually tell us? In late July, Powell reminded us that they use core CPI. Core CPI excludes food and energy, and I know we can complain about that all day because food and energy is pretty much all we buy, right? If you look at the Visa bill, it's food and energy and clothes for my wife.
Right.
But food, energy, and clothes.
Yeah, Amazon.
And Amazon. And the list starts going on and on once you get into it. But a lot of it is food and energy. And to the Fed's point, the prices of food and energy are volatile, right? We've seen in 2 years, the price of crude oil has gone from negative, minus $30 to $120. And then just over the last few months, it's gone from 120 to about 90. The price at the gas station has gone from here, it was getting close to $6, and now we can start seeing it near almost $4. So it's volatile. So the Fed says, you know what? We know those things are important, but we strip them out. Let's look at the core. And the core last month was, I believe, 6.5, and that was the same as the month before. So yes, the volatile items are coming down, and we knew that. We've been talking about that for 2 or 3 months. We know that used car prices have come down. We know that gas has come down. We know that food commodity prices are starting to come down, although food is not coming down yet in the CPI index.
That's right.
The problem is that a third of the CPI number is housing, and it's not really just housing, it's rent. And house prices are coming down. At least there's anecdotal evidence of that. And again, Lance and I have bemoaned this, that it takes a long time for that to hit the data. But rents are still very sticky and not really showing signs of coming down. And as people's rents come due, after a year or 2 years, whatever their term is, those are going to be increased. Yeah. So there's a lot of people who will see a rent increase. It's just not their time yet.
Yeah. And look, and another thing, too, that nobody's really talking about much is wage growth. One thing in particular here is that wage growth has been very strong. And interestingly enough, if you just, and again, there's a lot of these economic reports that people kind of just gloss over and they don't really pay much attention to them. But the labor productivity report that just came out earlier this week was very interesting because it showed a very sharp decline in labor productivity and a big increase in wages. Now, that's also very inflationary, and there's a very high correlation between those indexes and particularly with wages and inflation, because ultimately those, and to your point, Mike, when it comes to the things kind of outside food and energy, a lot of the other things that are getting passed on to consumers are still containing a lot of those wage increases, et cetera. So there's a case here that, while inflation may have peaked here, that it'll come down slowly, but there's nothing that actually precludes another ramp up in inflation over the course of the next few months if we don't start to see some of these bigger items like homeowners equivalent rent or wages and some of these other areas actually start to come down as those feed back into that inflation calculation. So again, this is one of the challenges here. Has inflation actually peaked and it's just going to start to go down every month from here, or is this a respite kind of on its way to potentially another bump in inflation before we actually get to the peak, which we may not actually see until 2023 as we start getting these bigger year-over-year comparisons. Quick break, come back, pick up with Michael Leibowitz. So we'll shift gears, talk a little bit about allocation, portfolios, investing in this environment, kind of how to navigate, where the markets are now and kind of what happens next. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Mexico is now upset. There's been like 1.5 million people, a lot of them from California, have now moved to Mexico City because of cheaper rent. Now Mexico City is getting very upset because they don't like the impact on their culture.
The Real Investment Show podcast.
Mexico City is getting very upset with the immigration and they want to stop it.
Don't American my Mexico.
Exactly.
At realinvestmentadvice.com.
It's like, stop it.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Of course, it's a Real Investment Show, talking a little bit about markets, money, your money in particular, investing. Of course, the CPI calculation came out yesterday. Ian Jersey from Bloomberg Strategist. Our analysis shows that lower volatility, read that as sticky components of core CPI, may have peaked in July. But the medium volatility sector continues to jump higher. If the low volatility, I know this is complicated, but bear with me a second. If the low volatility cluster, that's the sticky stuff, stabilizes at the higher level, those combined trends may keep core CPI underpinned and the Fed hawkish. The better than expected core CPI print will be a strong positive for the Treasury market, particularly in the long end, so the knee-jerk reaction is unsurprising. The strong steepening of the curve likely won't last. However, as the better than expected core still doesn't mean it will fall. In fact, although better than expected, the core may be stickier than the market seems to be anticipating. And that's really the trick here that Mike and I are talking about. There's, again, you can make a case for the bullish argument. Technically, you can make a case. And again, a lot of the comments yesterday from economists across the street were basically, this means that the Fed is done hiking rates. They're going to pivot now. This is a necessary print for the Fed, but it's not sufficient. We need to see more. Is the other side of this, equation. So again, both sides of this, argument, depending on how you kind of lean personally, you can make a case for investing capital. The problem is as is always the case, is what if you're wrong, right? I mean, you go all in here expecting markets to, for the Fed to pivot and stop doing what they're doing and turn dovish and start doing QE. And if they don't, you risk capital. The other side of the equation is you sit tight, you don't do anything, you stay bearish on the markets, and the markets keep running higher because, well, they can do that. We've got roughly $13 billion a day coming into markets over the course of the next week from stock buybacks. We've got 90% of the S&P 500 reporting. And so now everybody's starting to push their earnings estimates out into the next quarter. And, we've got a lot of stock buyback announcements. And that's been a strong underpinning for the market. You've got a lot of negative sentiment. You've got a lot of cash sitting out there by money managers who are underweight equities, and you've got a big short position on equities because of the decline. And a lot of this rally over the last few days has been short covering. We've seen a lot of short covering over the last couple of days, in particular, and that's driving the market. So as the market goes higher, it drags more and more investors back into the markets, but that isn't sustainable long term. So see, there's these challenges, right? So that's the question that Mike and I are discussing this morning was how to navigate this, because again, we need to make money, we need to be invested, we need to grow our capital, but how do you do that in such a, shall we say, unstable environment where things can change very quickly, and with a market that's as fickle as it's been as of late, one economic data point to the next can, lead you to have either a 2% advance or a 2% decline in a single day. And that kind of volatility is tough to navigate. Mike, your thoughts?
Yeah, it's incredibly difficult. And, you and I kind of debate it. Sometimes we're on the same page, sometimes we're on a different page every day. But I debate it internally. Maybe we should be more bullish. Maybe we should be more bearish. What's going on? And the one thing that I keep thinking about is spring of 2020. COVID hit in early March of 2020. Market dropped significantly. The economy shut down. And to a degree that, we didn't even see during the Great Depression. I mean, it was literally shut down in so many ways that are just unthinkable that no one would have predicted. And the economy was a disaster. Unemployment rate dropped immediately. What did it get to? Minus to 13, 16%? I mean, it was an unbelievable. I still remember the New York Times had that one graph where the unemployment rate took the whole, it was like this, and then it just shot up and it took the whole page of the front page of the New York Times. So, I mean, it was unprecedented. But what happened in late March and through the spring of 2020 was that the Fed came in with their cavalry, and they added, $2 trillion, $1.5 trillion of liquidity within 2 months. There was some fiscal stimulus. Liquidity flew into the system, and the market from that point on just took off. Didn't matter that the economy, even in June or July, was still in shambles. Didn't matter that we had no idea what COVID was, or that everyone was scared and staying in their houses and not going out, and that travel was pretty much no one was traveling. I mean, just not going out to restaurants. I mean, it's just fundamentally that situation was awful. But liquidity wise, it couldn't have been better. I don't think there's never been a situation with that much liquidity flowing through the markets. So as I kind of weigh all these bullish bearish arguments, and there are a lot of good bullish arguments, a lot of good bearish arguments. And, we can talk about CPI, we can talk about GDP, employment, what's going on with Russia, Ukraine, what's going on with China, Taiwan, the U.S.'s relationship with Russia and China. And we can debate that stuff all day, and that may help move the meter a little bit. But again, I keep going back to liquidity. So it's, what will the Fed do? Will they back off? And there's two forms of backing off of the Fed. The market keeps talking about Fed stalling, Fed pivoting. That's just in relation to interest rates. And that partially does help or hurt liquidity. But what no one is talking about is QT. That's where the Fed is reducing their size of their balance sheet, again, by $95 billion a month. That's a huge amount. They were adding 120 a month at one point, which is even more, crazier. But they're still going to be taking out $95 billion a month. And that, for me, that tips my scales. It doesn't mean I'm uber bullish and we're going to sell everything and sit on cash and wait for doomsday to occur. But as we have these discussions, it keeps a constant skew, to my opinion, to the bearish side. Because when the Fed removes liquidity, it's bearish. When the Fed adds liquidity, it's bullish. And so that's how I skew my opinion. But it doesn't mean that the market can't have Lance isn't going to call it a bear market, a correction market rally, a bear market rally, that we can't go up to 4,500 on the S&P, which is another 300 odd points higher from here, called 7-8%, because fear of missing out, sentiment, all those things in the short term can dwarf liquidity in the very short term. But, when you're looking out months, 2, 3 to 6 months, I think liquidity is going to win the day. So what's the Fed going to do?
I know, and that's the big question. What's the Fed going to do? And it's interesting because, there's so many opinions, right? I mean, we were just talking about, the Fed's going to the Fed is going to hike rates in September, right? I mean, that's just a kind of a foregone conclusion at this point. So that's going to get us to about 2.75 on the Fed funds rate. Then, of course, a lot of people saying, well, they'll stop there, right? That's going to be that'll be the last rate hike, and they're going to pause at that point, kind of wait and see what happens with inflation. But you've got people, inside the Fed itself, Neil Kashkari, among others, and of course, just recently, the St. Louis Fed president coming out talking about they need to get to 3.5% to 4%. So that certainly doesn't augur that they're going to be slowing rate hikes anytime soon. Maybe they cut back and only doing 50 basis points a session, or maybe 25, but they're still going to be hiking rates. And as long as, and again, I think kind of what the market may be missing is that all of a sudden the markets have kind of become accustomed to, okay, 8% inflation. Okay, it's 8% inflation. That's good. We're okay with 8% inflation. 7% would be great, but 8% is good. The Fed wants to get to 2%, right? If the Fed wants to get to 2% and inflation is only coming down slowly, and inflation is still running at 5, 6, 7%, by the end of this year, I find it hard that they're going to sit there and go, well, we'll stop here at 2.75% and just kind of see what happens.
Right. Lance, if you just strip out gas or energy out of the number yesterday, the monthly number would have been up between 0.4, 0.5%.
Yeah.
That's 5 to 6% on an annualized basis. Just, that's the effect that energy had. It went from, I think it was 0.45 to 0.
Right.
And that was a huge drop. And we saw that drop, and we knew that drop was coming. But how much of that is already factored in? Was it, what point of the 120 a barrel to 90 a barrel was caught all in 1 month? Right. So now if we just stay at 90 a barrel, it's not adding, but it's not subtracting from CPI either.
Right. And again, then we go back to wage growth, we go back to housing, homeowners equivalent rent, and those may start to stabilize, but there's not big evidence of those coming down just yet, right? There's still kind of this tailwind push in those prices, and it's going to take a while before we start to see those rents come down, which is going to take longer. Again, this is just the argument goes back to the fact that if you're betting your allocation right now on the fact that the Fed is about to, and again, I'll go back to Jim Paulson, from Leuthol Group, saying the Fed is already starting their easing campaign, if not about to start one. And there's really, that's what you need to have this return of the bull market, so to speak, where you just allocate 100% of your money to stocks and, going down the road. From the look of it, it seems like markets are really kind of getting back ahead of themselves again, especially in the more speculative areas of the markets. Again, we've talked about meme stocks, taking off here recently. A lot of the most beaten up stocks having big rallies, stocks like AMC, GameStop, Coinbase, others. Retail investors likely taking on a lot more risk than they realize, given the fact that, again, and what we'll come back from the break and talk about is earnings as we start to go through the rest of this year. Don't go away. Be right back on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Get ready to wrap things up. I want to shift our focus. So talking about inflation, of course, the challenge here is investing in this environment. How much risk do you take on? Do you believe that inflation has peaked? If you do, then if you believe inflation has peaked and the Fed's about to reverse course, then you need to be buying stocks. However, the other side of the argument is that there's very little evidence here that inflation, while it may have peaked, is not going to come down sharply enough at this point to get the Fed to back off of hiking rates. And there's certainly no indication that they're in any rush not to stop reducing their balance sheet. They don't like having a $9 trillion balance sheet, right? That's not really where they want it to be. And, so them wanting to reduce their balance sheet, they need to get that number down so they have the ability to use that tool, in the future. And this really kind of goes on a couple of different fronts, right? They need to get interest rates up enough that they've got some room to lower interest rates to combat the next recession when and if it shows up. And the same thing for the balance sheet. And so there's no indication right now that from the bullish standpoint that the Fed's going to be doing anything other than what it's doing right now. While they may stop hiking rates at some point, certainly doesn't mean they're going to start cutting rates. And if you go back and look at the 1970s is a good example of this, the point where you wanted to buy stocks was when the Fed started cutting their rates. And the reason they were cutting rates is because the economy was dropping into a recession. That's why they cut rates, right? They're using that policy tool to bail the economy out. That's when you want to start buying stocks. When they start doing QE and cutting rates, that's where you want to be buying stocks. Until then, though, stocks tend to be under pressure. But I wanted to shift this focus a little bit to earnings because we're just wrapping up earnings season for quarter two. Again, it was an interesting earnings season from the standpoint that earnings weren't as bad as expected. Now, the real question is how long can you keep rallying on not as bad as expected? Let me give you a good example. This morning, Disney reported earnings after the bell yesterday. And stock's going to be up about 8% today. Now, the stock's been beaten down, beaten to death. This is one of the, kind of the meme stock group, right? The retail traders, they love Disney. And stock's been really beaten up because of the whole, downturn in the markets and the economy, et cetera. Now, Disney reported earnings yesterday and the stock's up. Now, so this is what was interesting. They reported Disney Plus subscribers, 152 million. That was a 31% year-over-year increase, beating estimates of 148 million. So that's a pretty good number, and that's why the stock is trading up. Now remember, Netflix has lost 3 million subscribers. They lost 2 million in the first quarter. They lost 1 million in the second quarter. Disney's still gaining subscribers at this point. Now they lost one yesterday because I canceled my Disney Plus membership because they raised their fees. And given the fact that I've now watched the entire Marvel movies like 6 times, with my kids, and my kids are now off to college, we're not going to be doing that anymore, and the new Marvel sucks. So there you go. So down 1 subscriber already, making a dent. But here's what they said. But here's the more important part about what they said after the bell. Their subscriber forecast. Okay, now remember, what did we say about their subscribers? 152 million subscribers. That's what they reported for the second quarter. What did they say about 2024? Their subscribers into 2024 will be 135 million to 165 million. So, in other words, if I'm already at 152, getting to 165 is not that big of an increase over the course of the next year, right? They did 14 million in 1 quarter, right? So, what they're telling you, and if you go the other way down to 135 million, well, that's a loss of subscribers. That's not good. So really the forecast for Disney is not that great. Certainly doesn't justify an 8% bump this morning, but that's what markets are doing right now, is right, retail investors chasing stocks. But this is the thing that we need to be paying attention to now going forward, because again, stocks rallied in this last quarter because of not as bad as expected. Now we've got to get back. You can't keep rallying stocks on not as bad as expected. Going forward, we've got to start beating better than expected. They've got better than expected earnings. That's going to be a little different change, particularly as high inflation. And this is the problem with inflation, right? At 8% or even at 7%, inflation at 6%, inflation at 5%. The economy's not geared because of the debt levels of consumers and the ability of wages to meet spending needs, et cetera. Real wages are still negative. So even an economy running at 5, 6, 7%, that's going to impact consumption. That's 70% of the economy. Where do earnings come from? Earnings come from consumption. So the real risk for the markets over the course of the next quarter to 2 to 3 is going to be a disappointment in earnings. Look, earnings estimates are coming down, but there's and I just looked at, I've got to update my analysis on the website here in the next few days, but I just took a look at S&P's earnings, and in the last month, earnings in 2023 have gone from like $240 a share to $210. So there's already been a big drop in earnings estimates, and those are likely going to get worse. But let me throw this over to Mike for a second, get his thoughts. Mike, what do you think?
Well, I think you nailed it right there. 70% of the economy is the consumer. So what's the consumer doing? We know, first of all, that they are getting raises to the tune of about 5%. But inflation, even with yesterday's glorious numbers, is still 8.5%. So they're really getting pay cuts of 3 to 4%. But here's what's important, that the consumer has been able to keep up consumption because of savings, because of credit cards, and I was going to say mortgage refinancing, but that ain't happening anymore. But if you look at personal savings is down to 12-year lows. So what has the consumer done? They've drawn down their savings and they've consumed. But the problem is, as you look forward, what can the consumer do with their savings? There are no savings for a good chunk of consumers. So that money cannot be spent anymore, right? So what do? You go to your credit card. And we find that credit card usage, new credit cards, everything about credit cards is soaring right now. So they ran out of savings. There's a generalization, but they kind of ran out of savings. They're leaning heavily on credit cards, but credit cards have maxes. And believe it or not, most people don't pay down their credit card monthly. They keep a balance. So
wait, I thought everybody just ran up like $20,000 credit card bills and paid them off at the end of the month. Doesn't everybody do that?
No, but here's an interesting thing, Lance. I think we talked about this a couple of years ago, maybe even before COVID. The credit card, my credit card, and I have a great credit rating and nothing has really changed. They dropped my credit limit. They brought it down, and they were doing it across the board. Capital One said something in a press release that they were actively bringing down people's limits.
No, they just brought down yours. They just said everybody because they didn't want to offend you, but it was just you.
Just because of and it's something about an affiliation to Lance Roberts. I didn't.
Yeah, that'll get you every time right there.
No, but bottom line is, as you use your credit card more and more, you have limited space on the credit card, but it also becomes a tax, right? You get the bill for the credit card, and
18%
if
interest.
you are running a balance, the expenses and fees are enormous, but you have to make those payments. So again, it is a source of spending, but it's a limited source of spending with a tax that hits your consumption in the future, being the fees and interest and repaying the debt. So the consumer has used credit and savings, but how much more of that is left? And that's where this whole
and that's what. Let me interrupt you real quick here, because it's a really important point that you're making. And when you see there's a lot of economic data points that get thrown around in the media, like debt to income ratios and household savings and these type of things. And what's important is that this is very much skewed to the higher income earners. And in fact, just a real time story yesterday. We had a conversation with a major credit card user, or issuer here in the United States, and we were talking to them about their demographics and kind of what's going on, and they made a very interesting comment about it, which was that where they kind of lose money on the group of demographic, the ones that we would be interested in, as investor managers, right, or investment managers. We're looking for those higher income earners with savings. They go, yeah, we have this group that pay off their credit card every month, and we lose money on them, right? That's because by the time we give them the rewards, on their credit cards, because they're, charging and then paying it off, we kind of lose money on that group. But since they have other assets, that, they make larger purchases and this type of thing, so they're okay. But the large group of our, where we make our money is on those that keep a revolving balance, right? And when they get, as they keep that revolving balance, that's where we really make all of our money. But so when you start, and so my point here, Mike, is that when we look at a lot of these statistics, we really have to step back. When you see a thing that says, debt to income ratios for households are at the lowest level in 20 years, it's not the case. It's only because that top 10 or 20% of income earners is skewing that data because they have a lot of savings and income, and they have no debt. They paid it all off during the economic shutdown. The other 80%, they're up to their neck in debt and adding on more right now.
I agree, and I think it would be amazing if you could pick like 10 people: Elon Musk, Bill Gates, and 7 or 8 cohorts of theirs that are, 100 billionaires. Mm-hmm. And you could just pull their data out. How much would it affect savings? How much would it affect debt to income? And I think even if it moved it by a couple tenths of a percent, that's amazing that 10 people can overshadow how many, 250, 300 million kind of adults.
Yeah, no, I think if you pull out the 1/10 of 1% or even the 1%, that all those ratios look drastically different. But,
right.
Go ahead. Last word. You got about 2 minutes. About 30. So about 30
Bill Gates
seconds.
And Elon Musk don't steer the economy. they certainly buy a lot of stuff, but they're not marginally buying more or less because of inflation or because their stock went up or down or because they got a little bit of a raise.
Yeah.
So that's not what we care about. Is the marginal change in consumption, and the marginal change comes from those that consume the most,
of course,
as a percentage of their income,
exactly.
and that's the lowest.
Yeah, that's exactly right. Of course, Elon Musk just sold a bunch of $7 billion worth of stock, so maybe needs some money. All right, that wraps up the show for the day. Be back tomorrow for the next edition of the Real Investment Show right here. Stay tuned into our website, realinvestmentadvice.com. Ask your questions, comments, emails. Check out simplevisor.com, our fully digital research platform, and, of course, our newsletter and daily commentary. It's all at the website, realinvestmentadvice.com. See you back here tomorrow.
It's a rich man's world.